Hi everyone, and thank you for tuning into my channel where I post videos daily talking about stocks, the stock market, and investing. In today's video, I will answer the question on many of your minds. Is Disney stock a buy? I'll be using my simple 6-step framework, so let's get right into it. The first step in my framework is the customer value proposition. For Disney, their theme parks, hotels, resorts are expensive. I mean, they're more expensive than most other similar offerings in the market today. But even though they're on the expensive side, they're in high demand. You will hardly ever visit a Disney theme park that's not completely crowded. Attractions are often backed up so long that waiting 45 minutes to an hour and a half is very common. So even though it's expensive to visit one of Disney's theme parks, hotels, or resorts, customers still generally feel like it's a good value. Otherwise, it wouldn't be as full as it usually is. Okay. Moving on to Disney's streaming services and streaming bundle. These include Disney Plus, Hulu, and ESPN Plus. Their pricing is on the lower end of the spectrum. Um, so, in contrast to its theme parks, Disney has chosen to price its streaming services on the lower end. Now, they did announce price increases will be coming up starting December 8th. The prices for the bundle, each individual service will be going up. And at the same time, Disney's gonna offer an advertising supported tier of the streaming services that you can get for a lower price. So overall, Disney's streaming services are a good customer value, and that's evident by its rapidly growing subscriber base. In fact, Disney recently surpassed Netflix in terms of total subscriptions. Disney now has 221 million total subscriptions across its streaming services after adding 14.4 million in its most recent quarter, compared to Netflix, which has 220 million subscriptions after losing roughly a million in its most recent quarter. Moving on to Disney's cable channels and live TV, it's expensive, and that's leading to millions of customer cancellations and streaming conversions. So, overall, Disney's customer value proposition is not great, and that's evident by its 10-year compounded annual revenue growth rate of just 5%. So if its customer value was better, I feel the revenue growth would be higher. This is even after following a major acquisition that was additive to revenue in 2019 when Disney bought Fox. So even after that major acquisition, 10-year compound annual growth has just been 5% in the last decade. Moving on to the next step, which is unit economics. Disney's theme parks are extremely profitable incrementally. Fi- it took a lot of fixed cost or sunk costs to purchase the land and build the attractions. However, the variable cost to maintain and service these theme parks are low. So with each new customer that comes in, it adds to Disney's bottom line substantially. Similarly, Disney's streaming and content distribution business lends itself well to economies of scale. It doesn't cost Disney any more, or it doesn't cost Disney much more to show its content to 100 million people compared to showing it to 10 million people. So each incremental subscriber adds to Disney's bottom line because that each new subscriber is not costing Disney anything. So that's just revenue that's adding to it. The next key step to consider in the valuation process is the total addressable market. Disney addresses several very large markets, one of them being advertising. Advertising supports a lot of Disney's cable channels and some of its streaming channels, and that will be even more so after Disney Plus launches an ad supported tier December 8th. In 2021, advertisers spent $763 billion globally, and that was after rising by 23% from 2020. Further, Disney participates in the hotel and resorts industry that was worth 1.5 trillion before the outbreak of COVID-19. Of course, travel crashed after the outbreak, but it could recover to 1 trillion in 2022. And then finally, Disney addresses hundreds of millions of households that pay for streaming or live TV content. So overall, Disney's total addressable market is massive. So competition for Disney is broken down into two. I broke it down into two different segments. Um, the first segment for its theme park industry, competition is light. You're not you're not going to see very much promotional activity for its theme parks. It doesn't send out coupons. Prices are really high, so competition for that industry is relatively light. It's difficult for competitors to expand, add new parks, and do all of that because of the massive capital investment that's required. However, it's extremely competitive for content distribution. Several new streaming platforms with introductory pricing have been launched, and that's leading to massive losses on the business units for the entire industry. So, Disney, in its most recent quarter, lost about $1 billion in its streaming segment, and it's because it felt like it needed to come into the market with introductory level pricing so that it can attract subscribers, and many of its competitors did the same thing, and that's leading to an entire industry that's pretty competitive and that's poor for profitability. So for now, competition is heavy in the streaming industry. The next step is valuation, and for Disney stock, it's relatively inexpensive when measuring with the price to sales ratio. As the chart shows here on the screen, Disney's price to sales of 2.6 is just about as low as it's been, dating all the way back before 2014. The only time it was around these lower levels in these past years is in 2020, right after the onset of the pandemic, when there was so much uncertainty in the market. Its theme parks had to close temporarily, and so it's understandable that the price would have fallen to that level in at the onset of the pandemic. So for Disney to be trading at a similar price to sales ratio as it was in those riskier and volatile times is evident that it's relatively inexpensive. The next step I will consider is risks. So for Disney, one of the major risks are the rapidly falling cable subscriptions. According to eMarketer, legacy pay TV households in the US is forecast to fall from 68.5 million in 2022 to 57.2 million in 2026. Now, that's partly why Disney launched its streaming services to absorb some of those customers that cancel cable. So there's a risk still, though, even after the launch of the streaming services, that the conversion between customers moving from cable to streaming is slower than expected, or Disney loses customers to other streaming services, or even after customers move to its streaming services, the streaming services end up becoming not as profitable as its legacy cable TV business at maturity. So this is a major risk Disney is facing. Secondly, another risk for Disney is the potential for an economic recession. These risks are rising because of the coronavirus pandemic and the secondary and tertiary consequences. The coronavirus pandemic has snarled supply chains worldwide, leading to widespread supply shortages, which have led to widespread inflation. Rising inflation is forcing the Federal Reserve to raise interest rates, which is starting to contract consumer activity. So, as consumers are forced to pay more for things like food, rent, and gas, that's going to leave less money for them to spend on discretionary items of the type that Disney offers, such as theme parks, hotels, resorts, cruise ships, and of the sort. So that's the second major risk Disney is facing. So the verdict, after going through all of the steps, let's consider if Disney stock is a buy. So when I considered its customer value proposition, I said it was good. It wasn't great because prices are so expensive, but customers still felt that they were getting a value sufficient enough to pay for those experiences. Then we considered Disney's unit economics, which were excellent. Each incremental customer is very positive to Disney's bottom line. Disney's total addressable market is also excellent. It addresses several massive industries. Disney's competitive position in the industry overall was good. It was broken down into two segments. The streaming industry's competitive pressure is extremely high, but in the theme park industry, it's not as high. So overall, Disney's competitive position is good. And then when we looked at Disney's valuation, we noticed that it was inexpensive, relatively speaking. When we looked at Disney's historical price to sales ratio compared to what it is today, it was relatively inexpensive. And then we considered Disney's risks, which I determined to be high. Disney's gonna be losing millions of cable subscribers, which is one of its more profitable segments. And we don't know if those are going to end up signing up to streaming subscriptions, and we don't know how much those subscriptions are going to affect the bottom line for Disney. And then Disney's exposed to the risks of an economic recession, curtailing consumer spending at its theme parks, resorts, and everywhere else. Okay, overall, after considering everything, I would still say Disney stock is a buy. Disney has one of the most favorable factors in its favor, which is the valuation. So even though risks are high and the customer value proposition is not excellent, the fact that it's trading so inexpensively makes me willing to overlook some of the other factors that are not so great. Okay, so thank you for joining me. Please like and subscribe if you liked what you saw today, and comment down below. Let me know what you think of Disney stock.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.